Mr. AG Asian Guy here. Silver went from $45 to $116 in 3 months. That's a 156% rally. Then it crashed 47% to $64. Now it's sitting in a consolidation range between $78 and $86. And most people watching these moves have no idea what's actually happening. They see the numbers, they see the volatility, they feel the fear and the greed, but they don't understand the psychological mechanics that drive these extreme movements. Today I'm going to show you exactly how silver's psychology works, why these patterns repeat with remarkable consistency, and what the current consolidation tells us about the next major move. This is not about prediction. This is about understanding the forces that move markets so you can position yourself intelligently instead of getting destroyed by volatility you don't comprehend. Before we go any further, let me tell you what this channel is about. I don't sell courses, I don't sell signals, I don't sell anything. What I do is break down market data, show you both sides of every argument, and give you the framework to make your own informed decisions. I'm not here to pump your bags or scare you into buying or selling. I'm here to help you understand what's actually happening in these markets. If you want hype, find another channel. If you want fear porn, find another channel. But if you want to understand the psychological forces that create these massive swings so you can navigate them successfully, stay with me. Now drop a comment right now. Where are you watching from today? I want to know what country, what city. I see viewers from all over the world on these videos: United States, Canada, United Kingdom, Australia, Germany, India, Singapore, Philippines, Japan, all over Asia, all over Europe. Let me know where you're tuning in from. And tell me, did you get caught in this silver volatility? Were you positioned for the rally? Did you panic during the crash? Or are you just watching from the sidelines trying to figure out what's happening? I want to hear your experience because understanding how real people are reacting to these moves tells us something about market psychology. Let me start with the fundamental insight that most people miss. Silver markets demonstrate extreme emotional responses that exceed rational valuation frameworks. Let me say that again because it's important. Silver's volatility reflects collective investor psychology amplified through leverage and momentum trading. This is not about fundamentals. This is not about supply and demand in the traditional sense. This is about human psychology, fear and greed, amplified through financial leverage to create movements that seem irrational but are actually predictable if you understand the underlying mechanics. The 156% rally followed by a 47% crash within months reveals how psychological forces dominate price discovery in precious metals. Unlike systematic market movements driven by fundamental shifts, silver's volatility reflects what happens when millions of market participants experience the same emotional state simultaneously. Fear-driven accumulation builds foundations during uncertainty periods. Momentum acceleration occurs when psychological resistance levels break. Euphoric speculation emerges as social amplification takes control. And finally, panic liquidation creates cascading selling pressure that overwhelms fundamental buying interest. This cycle repeats with remarkable consistency. If you've been watching silver for any length of time, you've seen this pattern before. The specific prices change. The specific time frames change. But the psychological sequence remains the same. Understanding this sequence gives you an enormous advantage because you can recognize where we are in the cycle and position accordingly instead of getting swept up in the emotional extremes that destroy most traders. Let me talk about price anchoring because this is crucial for understanding what happened. The $50 level operated as a psychological anchor point for decades. Since 1980, when the Hunt brothers tried to corner the silver market, $50 has been this ceiling that silver could not sustainably break through. Every time silver approached 50, it failed. This happened in 2011. It happened multiple times since then. The $50 level became embedded in market psychology as the ultimate resistance. When silver broke through $50 in October 2025, it triggered something profound. This wasn't just a technical breakout. It was a psychological permission slip for aggressive speculation. Algorithmic trading systems that had been programmed to buy breakouts activated. Trend-following strategies that had been waiting for confirmation piled in. Retail traders who had been told for years that 50 was impossible suddenly believed anything was possible. The breakthrough validated bullish narratives that had been building since 2020 and attracted momentum-driven capital allocation at a pace that overwhelmed normal market function. Let me give you the key psychological price levels, because these matter for understanding both past moves and future potential. At $50, you have the historical resistance breakthrough that triggered algorithmic buying activation. At $70 to $80, You have the current consolidation zone where institutional accumulation is occurring. At $100, you have round number resistance that creates a significant retail psychological barrier. At $116, you have the recent peak memory that creates technical resistance as a ceiling, and at $64 to $67, you have the crash low zone representing maximum bearish psychology. These levels matter because market participants cluster their behavior around them. When prices approach these zones, predictable patterns emerge. Buyers step in at support, sellers emerge at resistance, algorithms trigger at breakouts. Understanding where these clusters exist gives you a map of likely market behavior. Now let me walk you through the anatomy of the rally because understanding how we got to 116 tells us something about how we got to 64 and where we might go next. Silver's explosive movement from $45.51 to $116.86 within 3 months demonstrates textbook speculative psychology. The rally began with cautious accumulation during late 2025. This reflected underlying concerns about currency stability and monetary policy effectiveness. Investors were worried about inflation, about debt levels, about central bank credibility. These concerns created a receptive psychology for precious metals accumulation. But the cautious accumulation phase is not what creates explosive rallies. What creates explosive rallies is the momentum phase, and the momentum phase activated when silver breached the $50 psychological barrier. This level had contained prices for decades. Its breach was particularly significant for algorithmic trading systems and trend-following strategies that were programmed to buy breakouts from long-term resistance. The breakthrough validated bullish narratives and attracted capital at an accelerating pace. Here's what happens in the momentum phase. Early buyers who accumulated cautiously see their positions profitable. They feel validated. They add to positions. New buyers who missed the initial move see prices rising and feel the fear of missing out. They buy aggressively, often with leverage, because they believe prices will keep rising. Social media amplifies the narrative. Stories of quick profits spread. More buyers pile in. Prices rise faster, which validates the buying, which attracts more buyers. This is a classic positive feedback loop that can push prices far beyond any rational valuation. The Shanghai Futures Exchange provided crucial psychological signals during the rally peak. Prices reached 38,000 yuan per kilogram, representing speculative euphoria in the world's largest physical silver market. When you see that kind of pricing in Shanghai, you know the speculation has reached extreme levels. Chinese market psychology differs from Western paper trading approaches. Physical accumulation traditions create strong buying during normal conditions, but speculative excess in China tends to resolve through rapid liquidation cascades once the fever breaks. Quick pause here. Let me ask you something. Did you recognize this psychology during the rally? Were you aware that we were in a euphoric phase, or did it feel like the beginning of something bigger? Drop your honest answer in the comments. No judgment. Understanding our own psychological reactions to these moves is part of becoming a better investor. If you got caught up in the euphoria, you're not alone. That's what euphoria does. It makes everyone believe the move will continue. Now let me explain the crash, because this is where most people lost money and still don't understand what happened. The crash from $116 to $64 was not random. It was not manipulation in the traditional sense. It was the predictable result of leverage unwinding through forced liquidation. Let me explain how this works, because understanding margin call psychology is essential for surviving silver markets. Leverage in silver markets typically operates with initial margin around 10 to 15% of position value and maintenance margin around 7 to 10%. This means a trader can control $100,000 of silver with only $10,000 to $15,000 of capital. When prices are rising, this leverage amplifies gains dramatically. But when prices fall, the same leverage amplifies losses. And here's where it gets dangerous. When losses exceed the maintenance margin threshold, brokers issue margin calls demanding additional capital. If traders cannot meet those margin calls, positions are forcibly liquidated regardless of the trader's conviction about long-term value. This creates a cascading effect that I call the margin call cascade. Here's how it works. Initial price moves trigger leverage calculations. Forced liquidation begins as margin requirements exceed account equity for the most leveraged positions. This selling pushes prices lower. Lower prices trigger additional margin calls for positions that had more cushion. Those positions get liquidated. More selling. Lower prices. More margin calls. The cascade feeds on itself, pushing prices far below where they would settle based on fundamental demand. The data shows that hedge funds and speculative traders experienced forced position liquidation to meet margin calls during the silver crash. This represents classic forced liquidation psychology, where leverage converts modest price, moves into dramatic percentage declines. A 10% move in silver becomes a 100% loss for someone on 10x leverage. When you understand this, you understand why silver can crash 47% in a matter of days. It's not about fundamentals. It's about leverage unwinding violently. Let me give you the key margin metrics because this helps you understand the mechanics. Initial margin is typically 10 to 15% of position value. Maintenance margin is usually 7 to 10%. Margin calls trigger when price moves exceed 5 to 8% against leveraged positions. And liquidation cascades occur when the forced selling from margin calls pushes prices lower, triggering more margin calls. This is why silver's crashes are so violent. The leverage in the system creates these self-reinforcing selling spirals that only stop when the leverage is sufficiently cleared out. Now let me talk about the current consolidation because this is where we are right now, and understanding consolidation psychology is crucial for positioning. Following the crash to $64.04 on February 6, 2026, silver entered a consolidation phase. The trading range between $78.50 and $86.30 represents an equilibrium zone where fear and greed are moderating toward rational analysis. This consolidation serves crucial psychological functions that most people don't appreciate. First, emotional reset. The extreme volatility created extreme emotions. Fear during the crash, greed during the rally. Those emotions need time to normalize before the market can establish a sustainable trend. Consolidation provides that time. Second, narrative reassessment. During trending markets, narratives become detached from reality. During the rally, everyone believed silver was going to $200. During the crash, everyone believed it was going to $40. Consolidation provides time for fundamental analysis to realign with price reality. Market participants can step back, analyze what actually happened, and form more rational expectations. Third, technical repair. The violent crash created oversold conditions that need time to recover without directional momentum. Technical indicators that were screaming extremes during the crash normalized during consolidation. Moving averages that were far from price begin to converge. This technical repair creates healthier conditions for the next directional move. Fourth, institutional reentry. Large institutional investors often avoid buying during crashes because they don't want to catch falling knives. Consolidation creates opportunities for patient capital to accumulate at reasonable valuations without the risk of immediate further crashes. This institutional accumulation during consolidation often sets the foundation for the next rally. The 50-day moving average at $79.84 provides psychological support by representing institutional money management anchor points. When prices approach this level, systematic buying emerges from trend-following systems and value-oriented accumulation strategies. This technical support becomes self-reinforcing as more participants recognize its significance. The current consolidation phase demonstrates healthy market psychology. Rather than continued panic selling or immediate bubble reformation, the trading range suggests participants are processing recent events rationally. Let me ask you another question. Are you accumulating during this consolidation phase, or are you waiting for lower prices, or are you waiting for confirmation of the next trend before committing capital? There's no wrong answer here. Different strategies work for different people with different risk tolerances and time horizons, but knowing your own approach and being intentional about it is crucial. Now let me discuss the Chinese physical market because this is a factor that most Western analysts completely ignore, and it's absolutely crucial for understanding silver's true supply and demand dynamics. Chinese physical trading dominates global silver markets. The Shanghai exchanges handle more physical silver transactions than Western paper markets. This creates unique psychological dynamics that don't exist in Western futures trading. The Shanghai Gold Exchange recorded dramatic silver outflows of 43 tons, dropping inventories to 450.5 tons. Meanwhile, the Shanghai Futures Exchange gained 3.7 tons, reaching 353 tons. Combined Shanghai inventories stand at 804 tons, which is 25.9 million ounces. These inventory movements reflect underlying physical demand psychology, despite paper market volatility. Chinese investors traditionally view precious metals through wealth preservation rather than speculative trading perspectives. This cultural psychology creates support during market stress as physical buyers emerge during price weakness. The upcoming Chinese New Year period historically demonstrates this pattern through premium expansion. Physical premiums in Shanghai tend to rise before major Chinese holidays as gift-giving demand increases. This is why I pay such close attention to what's happening in Asian markets. The Western paper markets, dominated by futures and ETFs, can create price moves that are disconnected from physical reality. But the Asian physical markets represent actual demand for actual metal. When Shanghai premiums expand while Western paper prices fall, it tells you the paper market is underpricing the metal relative to physical demand. When Shanghai premiums contract while Western prices rise, it tells you the paper market may be getting ahead of physical demand. The 9-day closure of Shanghai metal exchanges for Chinese New Year creates additional uncertainty. Historical precedent shows 5 to 12% price corrections during similar periods when Chinese physical demand is temporarily offline. However, these corrections typically generate strong rebounds once physical trading resumes. This creates both risk and opportunity depending on how you're positioned. Let me give you the bearish case now because I always present both sides. Here's what could go wrong from here. First, the consolidation could break down. The current range between $78 and $86 is not guaranteed to hold. If prices break below 78 with conviction, we could see another leg down toward the $64 crash lows. The leverage has been reduced, but not eliminated. Another wave of forced liquidation is possible if key support levels fail. Second, the psychological damage is severe. A 47% crash creates lasting psychological trauma for market participants. Many traders who got burned will not return to silver for months or years. This reduced participation can limit upside potential during recovery phases. Third, technical indicators remain weak. Price holds below the falling 20-day exponential moving average at $84.23. The RSI at 43.47 sits below the 50 midline, confirming weak momentum rather than capitulation. Below the dynamic cap, rebounds could fade on approach to the moving average and keep the sequence of lower highs intact. Until price closes above 84.23 with RSI reclaiming 50, risk stays skewed toward further weakness. Fourth, speculative excess may not be fully cleared. While significant leverage was unwound during the crash, some speculative positions may remain. If those positions face additional pressure, we could see renewed selling. Fifth, monetary policy uncertainty remains elevated. The Federal Reserve's path forward is unclear. If rates stay higher for longer than expected, or if the incoming Fed chair proves more hawkish than anticipated, precious metals could face continued headwinds. Sixth, industrial demand could weaken. Silver has dual demand from both monetary and industrial uses. If economic growth slows, if solar panel installation decelerates, if electronics demand weakens, the industrial component of silver demand could decline, removing some of the fundamental floor. These are real risks. I'm not dismissing any of them. The bullish case is not guaranteed. Nothing in markets is guaranteed. You need to understand the risks and position accordingly. Now here's the bullish case. First, the consolidation is healthy. Instead of continued panic selling or immediate bubble reformation, we're seeing rational price discovery. This is exactly what you want to see after extreme volatility. It suggests the market is building a foundation for sustainable movement rather than setting up for another violent swing. Second, physical demand remains strong. Shanghai premiums indicate continued physical interest despite paper market volatility. The inventory movements between SGE and SHFE suggest active physical market participation. Central banks continue accumulating gold, validating the monetary demand thesis that supports all precious metals. Third, the debasement trade is accelerating. Ongoing monetary policy uncertainty, elevated debt levels, persistent deficits, these factors create environments where investor concerns about currency stability drive capital toward hard assets. Goldman Sachs explicitly acknowledged the debasement trade as a key force behind precious metals demand. This institutional validation provides psychological support. Fourth, the leverage has been cleared. The crash eliminated the most over-leveraged positions. What remains is stronger hands with longer time horizons. This creates a more stable base for the next move higher. The speculative excess has been purged. The foundation is more solid. Fifth, key support levels are holding. The 50-day moving average at 79.84 is providing support. Prices have stabilized above the crash lows. This is constructive behavior that suggests buyers are emerging at these levels. Sixth, silver's dual demand creates asymmetric upside. Industrial demand from solar panels, electronics, electric vehicles provides a fundamental floor. Monetary demand from investors seeking alternatives to fiat currency provides speculative ceiling effects. When both demands align, silver can move explosively higher. Seventh, the gold-silver ratio remains elevated. At current levels, silver appears cheap relative to gold based on historical patterns. If the ratio compresses toward historical norms, Silver outperforms gold significantly. This ratio compression typically occurs during the mature phases of precious metals bull markets. Eighth, central bank buying validates the thesis. BRICS nations' coordinated gold accumulation reflects a collective psychological shift away from dollar-centric monetary systems. This institutional validation provides psychological comfort for individual precious metals investors and creates structural demand that supports prices. Here's what I'm watching to confirm or deny these scenarios. First, the 84.23 level. This is the 20-day exponential moving average. A daily close above this level would ease technical pressure and shift near-term momentum. Below this level, rallies are likely to be sold into. Second, the $78 support. This is the lower end of the consolidation range. If this level fails, we could see another test of lower levels, potentially back towards 70 or even the 64 crash lows. Third, Shanghai premiums. If premiums expand, it indicates strong physical demand that should eventually pull paper prices higher. If premiums contract or go negative, it suggests physical demand is weakening. Fourth, RSI crossing 50. The RSI at 43.47 indicates weak momentum. A move above 50 would confirm improving momentum and increase confidence in bullish scenarios. Fifth, volume patterns. Healthy consolidations typically show declining volume as participants wait for resolution. Volume expansion on breakouts confirms the validity of the move. Sixth, Chinese market behavior post-holiday. When Shanghai reopens after the Lunar New Year closure, how do Chinese traders behave? Strong buying would be bullish. Continued selling would be bearish. Let me talk about risk management because this is where most people fail. Effective risk management in silver markets requires acknowledging the psychological nature of extreme price movements. Traditional fundamental analysis often proves inadequate during periods of emotional excess. You cannot value silver the way you value a company's stock because silver doesn't generate cash flows. Its value is determined by collective psychology about money, currency, and store of value. Time horizon management is crucial. Maintain a long-term perspective to avoid getting manipulated by short-term volatility. If your thesis is that silver should be higher over the next 5 years based on monetary and industrial factors, don't let a 47% crash shake your conviction. But also, don't be so committed to your thesis that you ignore evidence it might be wrong. Emotional discipline is essential. Develop systematic approaches that minimize emotional decisions. Decide in advance what you'll do if prices reach certain levels. Write it down. Follow your plan. Don't make decisions in the heat of the moment when prices are crashing or soaring. Volatility acceptance is necessary. Recognize that extreme movements are normal in silver psychology. A 47% crash is not a black swan event in silver. It's just what silver does. If you can't handle that volatility, reduce your position size until the volatility becomes manageable. There's no shame in smaller positions. There's plenty of shame in blowing up your account because you couldn't handle the swings. Diversification strategy matters. Spread risk across different instruments. Physical silver has different characteristics than paper silver. Mining stocks have different characteristics than the metal itself. A diversified precious metals allocation can reduce the volatility of any single component while maintaining exposure to the overall thesis. Let me ask you one more question before we wrap up. Given everything we've discussed, what's your strategy for the current consolidation phase? Are you buying the dip? Are you waiting for confirmation of direction? Are you staying away until volatility subsides? There's no right answer. But having an intentional strategy is crucial. Drop your approach in the comments. I'm curious how the community is thinking about this. 3 key takeaways, and we're out. Number 1, silver's 156% rally and 47% crash demonstrate how psychological forces dominate price discovery. The move was not random. It followed predictable psychological phases: fear-driven accumulation, momentum acceleration, euphoric speculation, and panic liquidation. Understanding these phases allows you to recognize where we are in the cycle and position accordingly. The $50 breakthrough triggered algorithmic buying and psychological permission for aggressive speculation. The crash was driven by margin call cascades, where leverage converted modest price moves into dramatic percentage declines through forced liquidation. This is how silver works. Accept it or avoid the asset entirely. Number 2, the current consolidation between $78 and $86 represents healthy market psychology. Emotional extremes are normalizing, narratives are being reassessed, technical damage is being repaired, institutional capital is re-entering. This consolidation serves crucial functions that create foundations for sustainable future moves. Key levels to watch are 84.23 on the upside, which is the 20-day EMA resistance, and $78 on the downside, which is consolidation support. A break of either level likely signals the next directional move. Shanghai physical demand and premiums remain crucial indicators of underlying strength. Number 3, risk management in psychologically volatile markets requires accepting volatility as normal rather than exceptional. Position sizing should account for the possibility of 30 to 50% swings. Leverage should be used cautiously, if at all. Emotional discipline through systematic approaches reduces the damage from impulsive decisions during extreme moves. Chinese physical market dynamics provide fundamental support during paper market volatility, but the 9-day Shanghai closure creates near-term uncertainty. Long-term structural factors including central bank buying, currency debasement concerns, and industrial demand remain supportive, but short-term technical indicators suggest caution until key resistance levels are reclaimed. The unresolved tension is this: silver has crashed 47% from its highs, but the fundamental case hasn't changed. Physical demand remains strong. Central banks are still buying gold. The debasement trade is still relevant. Industrial demand is still growing. But the technical picture is damaged, and the psychological trauma from the crash will take time to heal. The consolidation is doing its work, allowing the market to process what happened and build a foundation for the next move. Whether that next move is higher or lower depends on factors we cannot know with certainty. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan and know your time frames. Are you trading short-term volatility or investing for long-term structural trends? These require completely different approaches, different position sizes, different risk management frameworks. If you don't know which game you're playing, the market will teach you, and that education is expensive. The psychology of silver markets is not a mystery. It's not manipulation in some conspiratorial sense. It's the predictable result of human emotions amplified through financial leverage. Fear and greed expressed through margin accounts and derivatives create the wild swings that characterize this market. Understanding this psychology doesn't guarantee profits, but it does give you a framework for making sense of movements that otherwise seem chaotic. I'm not going to tell you silver is going to $200. I'm not going to tell you it's going back to $40. What I'm going to tell you is that if you understand the psychological mechanics we discussed today, you'll be better equipped to navigate whatever comes next. You'll recognize the signs of euphoria before you get caught at the top. You'll recognize the signs of capitulation before you sell at the bottom. You'll understand why consolidations matter and what they're telling you about future moves. Silver will continue to experience extreme volatility. That's not a bug, it's a feature of this asset. Investors who develop psychological literacy, who understand the cycles, who position appropriately for the volatility, may find themselves better positioned to navigate what lies ahead. Use your brain. Don't follow anyone blindly, including me. Do your own research. Make your own decisions. Understand the risks. Have a plan. Follow your plan. And remember that in markets as volatile as silver, the biggest risk is often not being wrong about direction, but being right about direction with the wrong position size and getting stopped out before the move plays out. That's the full picture. Both sides. The bullish case and the bearish case. The psychological mechanics and the technical levels. The risks and the opportunities. This is what I do on this channel. No hype, no fear. Just the data and the framework to make sense of it. Let me know in the comments what you think. Is the consolidation building a foundation for the next rally, or is this a bear flag before another leg down? Where do you see silver by the end of this year? I want to hear from you. Mr. AG Asian Guy, out.